Hello everyone, welcome to our podcast. So in this video, we'll be discussing about viral value. So this basically means how social media reshapes the way you think about your wealth. And in this discussion, we have PlanAhead Wealth Advisors founder and CEO, Mr. VishalDhawan. Hello Vishal.
Hello Harish, nice to have you on the show.
Likewise. So to begin the conversation, so let me start with the most basic and obvious question regarding social media, which is regarding the way currently social media is a constant part of our lives, and news and opinion constantly flows to the investor on a real-time basis. So from a wealth perspective, this should have a the change in the perspective, the way people and investors think about money and investing.
Yes, I think it's been a very fundamental shift. If you go back and think about how investors, looked at making financial decisions earlier and what was the context behind it before social media sort of took over, essentially you looked at your portfolio at a reasonably lower frequency. You normally looked at events taking place in a newspaper, maybe you read a news item in a news bulletin, you met a financial advisor on a particular frequency, discussed the overall picture, and then decided what you wanted to do with your investment choices and investment decisions. All of a sudden, as social media has become more prevalent, you're constantly getting bombarded with opinions about what is right or wrong. And the way algorithms are built around social media, as you're aware, is that the more you see a particular type of reel or a social interaction, the more those kind of reels will now hit you. And therefore, because you keep getting the same message again and again, there is a tendency to start to believe that that is the right thing for me because it is coming up on my social media more than once. And therefore, opinions get formed very quickly, which could actually either be good opinions or not so good opinions. And therefore, I think there's a huge need for us to somehow slow down the way we respond and react constantly to all that is hitting us on social media.
Okay. Got it. Now, to the first question, there is also another part which is regarding the term called visible wealth. Now, due to the influencers, the social media stars, the way they portray their lifestyle, their milestone, their experiences, so surely that should have a visible impact on the financial behavior of the investors over time.
Oh, it definitely does. So if you go back and look at what social media does, it's very focused on outcomes. It has very little focus on process. So, you will see these typically focused through lifestyles which are very fancy. Fancy holidays, fancy houses, fancy cars. So the constant message that you're getting is that what I have with me today is inadequate and not good enough because it doesn't match what you see on social media. I think it's very important to keep in mind that to get to those fancy holidays, fancy cars, fancy houses, if you do endeavor to get there, there is a process of wealth creation that you will have to go through, and that process is going to be key rather than outcome. What ends up happening is because we want to get to outcome very quickly, very often we are trying to speed up the entire process.
Sure.
And most of the times you will find that speeding up actually works against you rather than going with what is well known in financial parlance as the law of the farm, where you essentially allow things to happen over a period of time so that you get the outcome that you want. But you don't try to do it too fast, because in trying to do it too fast, you could sometimes make some very fundamental mistakes, which can take you back in time.
Okay.
And the more you make those mistakes, the more the gap appears between that visible wealth and where you are, and the more impatient, the more uncomfortable you start to get, and therefore you then start to make more mistakes. So it's a classic chain that I think everyone needs to avoid to get good outcomes.
Got it. Totally agree with that. And also like to shift our conversation a little bit on the business opportunity part, which social media provides an opportunity for various market participants to use it for their business opportunity, especially nowadays in the private market space. So there is certain trend around this, and this has a importance in our discussion of viral value. And what risk does it also introduce to our viewers?
So I think private investing has become very popular all over the world, and India has not been immune to that. Part of it happens simply because it's so much easier to have narratives around growth, narratives around opportunities, narratives around exclusivity, narratives about, if you don't do this, you could miss out. So there are so many narratives that you can create around private businesses because they aren't as regulated, they aren't subject to the same codes that public companies are subject to, etc. And also the kind of research that is available on them is fairly limited. So what we do end up finding is that this combination of exclusivity on one side and narrative on the other can actually be very damaging for investor portfolios if they don't step back and ask themselves, saying that what really is the opportunity that is being captured here, and is this company best positioned to capture that opportunity?
Okay.
Because what could happen is sometimes the opportunity could be very big, but the business may not be in the best position to capture it because of the team behind it, because of the ecosystem that they have tried to build, the model that they are trying to build around, etc. Or sometimes just the size of the opportunity may not be attractive enough, or sometimes both of these are in place, but the prices are so high that you're paying for it, that you're essentially in this endeavor ending up buying something which is probably going to be worth much lesser than what you were imagining it was worth, because you overpaid at the start itself.
Okay. Now this also brings up an important aspect of the social media, and when we are discussing about business opportunities where products are being delivered to the investors, the point that is important is the credibility of the opinions and the way news are being floated to consumers of the contents. So how should listeners think about credibility of such information where the information itself is so crowded?
So I think it's important to go back to asking yourself, saying that who's this person who's speaking what it is digitally, and what is the kind of experience that that person really brings to the table to be able to talk about this subject. I think what we've found is very often that when you go online, you'll see a lot of people are trying to drive eyeballs because they need more people to come, follow them, like them, because they may have revenues which are linked to that. What does tend to happen very often when that takes place is that there is a tendency to create sensationalism, eye-catching headlines, topics which are trending, just because you know that you are likely to get the best viewership and the best promotion for yourself as a result of that. And a lot of times mistakes end up getting made in this process because things are oversimplified to ensure that the audience that you're appealing to gets the message that you want them to give. I think it's important to segregate the need to be simple with the need to also be truthful and correct. And what we find very often is that that is the missing link, because information may be shared only partially, creating an impression that the viewer is not aware enough as compared to the person who's delivering that message. And I think it can create a lot of challenges for people.
And you mentioned about trend. So I have a question regarding this. Now we see there are cycles where certain ideas and certain asset classes are favored or talked about more and more, and this can be also positive side for that topic or a negative side for the topic. So I think there are some patterns also visible on that part. So how should investors think about this pattern?
So I think cycles have always existed, right? And I think investors always need to be mindful that ultimately there will be a reversion to mean that will take place. Cycles that are doing extremely well will go through a downturn. Cycles that are doing very badly will come back, and there will be an equilibrium that will ultimately get formed. I think what tends to happen is that the way cycles get explained right now um, makes it create a feeling of being left out if you have not participated in that particular cycle. And we've seen it very recently with precious metals, for example, that there seemed to be a frenzy for people to participate.
Mm-hmm.
So the cycle may be favorable for participating in precious metal like gold because geopolitics world over has started to become a challenge. Dollar debasement is a real challenge for a lot of people to deal with. But what price are you paying in that cycle to be able to participate in that particular asset class then gets forgotten because the focus is so much on the cycle itself without trying to figure out which part of the cycle you might already be in. And therefore, are you already buying that asset when it is too late, or maybe selling that asset at the wrong time because you may be at the bottom of the cycle. So we do believe that cycles need to get understood and then they need to get mapped to your investment portfolio. So if you are investing for 20-30 years, you may be okay with not worrying about the cycle significantly because over that period of time you might see 2, 3, 4 cycles and you will be okay.
Yeah.
But the problem with cycles very often is that it starts to get people who have very short-term money which they require in the next 6 months, 1 year, starting to predict where the cycle is, and then end up investing that money and then finding 6 months or 12 months later that they entered at the wrong part of the cycle. And a lot of this happened simply because, again, the way social media works is that you will have examples of people who entered the cycle earlier and made a lot of money. And they are positioned as the ambassadors of wealth creation from that particular asset class. Or you will find that, because there is constantly algos which are throwing that up to you, you will start to believe that that is the real truth.
Yeah.
And very often you will lose context of your own needs of money. What is there? What is the risks? What can go wrong? All of that gets forgotten because the focus is so much on the cycle and maybe a particular asset class in that cycle.
Yeah, totally agree. Got it. I think focus is a key aspect to that. And before we close in our conversation, so what's the key core takeaway in the current situation the investor should think about the long-term wealth when they are thinking about investing and about their money?
So I think it's very important to keep in mind that viral value and enduring wealth are two different things. So viral value is about you having made the right choice, hopefully more than once. Enduring wealth is typically, in our experience, built around structure, patience, context of your own financial life. And I think the need to be able to segregate these two things out is very important. I think what happens virally is things happen fast. What you need to create enduring wealth is normally that you have to be thoughtful. You have to think carefully about why am I doing what am I doing and what are the likely outcomes. In any decision that you end up making, there is no one single outcome that is only going to happen. There could be a range of outcomes, and what you need to ask yourself is saying that if I get this outcome, what will it mean for my financial plan? If I get this outcome, what will it mean? And if I get this outcome, which is the most terrible outcome, what does it really mean for my financial plan? I think when you start to be thoughtful, patient, structured, all of a sudden you start to now see that there is a real chance to create enduring wealth, which is ultimately the objective of most families, saying that what I see today needs to be sustainable out, hopefully across generations and not just across my lifetime.
Okay. Enduring wealth. I think not reacting to news and more about focusing on wealth creation and discipline, structure, the key aspects in our conversation. Okay, I think we close our conversation for today. If you liked our video, please like, subscribe, and follow our channel for more upcoming videos. Thank you everyone. Thank you, Vishal.
Thank you, Harish.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.